Is it taxable for foreigners' investment in real property? FIRPTA. The Foreign Investment in Real Property Tax Act, FIRPTA, is a U.S. federal tax law designed to ensure that foreign individuals and entities pay taxes on the sale or disposition of U.S. real property interests. Enacted in 1980, FIRPTA imposes specific withholding requirements on such transactions to secure tax compliance. When a foreign individual or entity sells U.S. real estate, the buyer is typically required to withhold a percentage of the sale price as a prepayment of the seller's tax obligation. The withheld amount is sent to the IRS to cover any potential tax liabilities arising from the sale. The standard withholding rate is 15% of the gross sale price. For certain sales under $1 million involving personal residences, the rate may be reduced to 10%. The foreign seller must file a U.S. tax return, Form 1040-NR or 1120-F, to report the actual gain or loss from the sale and determine the final tax obligation. If the withholding exceeds the actual tax liability, the seller may receive a refund. Includes land, buildings, and certain interests in entities holding significant U.S. real estate, for example, real estate investment trusts or partnerships. Defined as a non-resident alien individual, foreign corporation, partnership, or certain trusts and estates. FIRPTA may not apply if the seller is a U.S. citizen or resident alien, or in specific cases like a certified FIRPTA exemption. If the buyer plans to use the property as a personal residence and the purchase price is $300,000 or less, no withholding is required. A foreign seller can apply for a withholding certificate from the IRS, Form 8288B, to reduce or eliminate withholding if the actual tax liability is expected to be less than the withheld amount. FIRPTA does not apply to sales by U.S. citizens, resident aliens, or entities not classified as foreign under U.S. tax laws. The buyer, or their agent, is considered the withholding agent and is responsible for ensuring FIRPTA compliance. Failure to withhold the required amount can make the buyer liable for the seller's unpaid taxes. Form 8288, U.S. Withholding Tax Return for Dispositions by Foreign Persons. Form 8288A, Statement of Withholding on Dispositions by Foreign Persons. Incorrectly identifying a foreign seller as exempt can lead to penalties for the buyer. Obtaining a withholding certificate from the IRS can take weeks or months, potentially delaying the sale process. Non-compliance with FIRPTA. Filing and withholding requirements can result in significant penalties for buyers and sellers. Work with a tax professional or attorney experienced in FIRPTA transactions to ensure compliance. Determine whether the seller qualifies as a U.S. or foreign person early in the process. Be prepared for the withholding amount and any steps needed to reduce it, such as applying for a withholding certificate. Ensure all forms and payments are submitted to the IRS within the required timeframes. FIRPTA can introduce complexities in real estate transactions involving foreign sellers, but proper planning and guidance can help ensure compliance while minimizing delays or financial burdens. Let me know if you'd like more details or help with specific scenarios. For personalized guidance, please reach out the award-winning Realtor, Syed Firoz, at 470-269-0420 or email spherosrealestate@gmail.com.